While social media screams that oil is dead and politicians pose in front of wind farms, the quiet money is doing something very different. Somewhere in a windowless conference room in Omaha, a small group of analysts slides a folder across the table to Warren Buffett. Inside, new models on cash flow, reserves, and dividend projections from the largest oil majors on Earth. The conclusion is uncomfortable for anyone who believes the green narrative is the full story. These assets are cheap relative to the monetary storm that is building. Not long after, Berkshire Hathaway quietly adds hundreds of millions of dollars in energy exposure, reinforcing its already massive stake in Chevron and other producers. No flashy press conference, no dramatic speech, just filings, cold and clinical, that reveal where one of the most disciplined investors alive is pointing his capital. Across the country, in an office built more like a research library than a hedge fund, Ray Dalio's team updates models on debt cycles, interest burdens, and historical currency resets. Dalio didn't build his reputation chasing trends. He built it by studying how empires rise and fall, how debt booms turn into debt crises, and how every monetary system eventually hits a wall. When his fund adds more shares of ExxonMobil, it isn't because he thinks gasoline prices will spike next month. It's because he sees energy as a core asset in a world sliding into the late stages of a long-term debt cycle. From the outside, the moves look almost boring. A few 100,000 shares here, another stake there. But in the context of global debt passing 300 trillion, interest costs exploding, and governments trapped between inflation and default, those moves become signals. They tell you that the top of the pyramid is repositioning. The mainstream narrative says we are moving away from fossil fuels, that oil is obsolete, that the future is digital and green. Yet the people with the longest time horizons and the deepest historical research are buying the one thing you cannot run a civilization without: energy. That is not contradiction, it is pattern recognition. And to understand why they are doing it, you have to understand the four-stage cycle that has destroyed currencies and reallocated wealth for more than a century, because right now we are living in stage 3. Picture a cafe in Berlin in 1922. A middle-class clerk sits at a table, carefully folding a few banknotes into his wallet after paying for coffee. He earns a respectable salary, has savings in the bank, a pension promised by the state. He has read about inflation in the newspapers, but it still feels distant, manageable. After all, Germany was once an industrial powerhouse with a trusted, gold-backed currency. That was stage 1. Solid money, booming trade, confidence that seemed unshakable. Then came the war. To fight it, the government suspended discipline and printed. They assumed victory would pay the bill. Instead, they lost, and the Treaty of Versailles demanded reparations so huge they could never be met honestly. Stage 2 began. Massive monetary expansion, justified as emergency policy. The numbers started moving faster than anyone could emotionally process. Before the war, 4 marks bought a dollar. A few years later, it was dozens, then hundreds, then thousands. By 9 months into 1923, prices were doubling every few days. Our clerk receives a pay raise and feels normal again for a week. Then bread costs 2 times more, then 5 times more. His bank balance goes up in marks, but down in purchasing power. His pension projections are now a cruel joke. This is stage 3, the crisis of confidence. When the public begins to understand that the unit they save in is dying. The government cannot stop printing, because the moment it does, the system collapses under the weight of unpayable obligations. Hyperinflation is not just a big number. It is a psychological event. By November, it takes trillions of marks to buy a single dollar. People rush to spend the moment they are paid. Contracts are rewritten in foreign currency or gold. Those who trusted paper find that decades of work have been wiped out in months. Then comes stage 4, reset. A new currency, the Rentenmark, appears, backed by land and productive assets. Stability returns almost overnight, but the damage does not reverse. The middle class, who held savings and pensions in the old money, is destroyed. Those who own factories, land, and energy assets survive, and often emerge stronger. The pattern is brutal but consistent. Asset-backed currency, expansion, crisis, reset. Today's investors, like Buffett and Dalio, know that story by heart. Shift the scene to New Hampshire, 1944. The Second World War is not over yet, but everyone can see who will win. Delegates from dozens of nations gather at Bretton Woods to design the new monetary order. The United States sits at the head of the table with two decisive advantages: the strongest industrial base and the largest hoard of gold the world has ever seen. The deal they structure is simple. Other currencies will peg to the dollar. The dollar will be convertible to gold at a fixed rate. This is stage one in a new form confidence built on tangible backing. Trade explodes. The post-war boom feels unstoppable. But the temptation of stage two returns. In the 1960s, the US launches ambitious social programs and fights an expensive war in Vietnam. The government spends more than it can cover with taxes and gold. Instead of cutting back, it prints. Foreign central banks notice that the number of dollars in circulation is growing much faster than the gold stored in American vaults. By the mid-60s, foreign claims on US gold exceed the gold itself. Charles de Gaulle decides he would rather hold metal than promises. France sends a battleship to New York, loads it with gold, and sails home. Other nations follow. The line at the gold window grows longer. By 1971, the system is mathematically impossible to sustain. President Nixon gathers his advisors at Camp David for a closed-door emergency meeting. The choice is stark. Either allow gold to drain out until nothing is left, or break the promise. That evening, Nixon appears on television and announces that the United States will suspend gold convertibility. In one speech, the world moves from stage two into stage three of the new cycle. The dollar is now backed only by confidence and military power. Many expected the currency to collapse. It did not, because American negotiators quietly built a new foundation. Treasury officials flew to Saudi Arabia and brokered a deal that would shape the next half-century. Oil, the most critical commodity on Earth, would be priced exclusively in dollars. In return, the US would provide security and a place to park surplus oil profits in treasury bonds. The petrodollar was born. The dollar was no longer a gold certificate. It was a claim on energy. As long as every country needed dollars to buy oil, demand for the currency stayed high. This allowed the US to run deficits and print at scale without immediate collapse. Stage two of the new order expansion through financialization accelerated. But the discipline of gold was gone, and once again, debt and promises grew far faster than underlying productive capacity. Fast forward to the early 21st century. The global financial crisis in 2008 exposes how leveraged the system has become. Trillions are created to rescue banks and stimulate demand. Interest rates are pushed to near zero and held there for years. Governments, corporations, and households all gorge on cheap debt. U.S. federal debt doubles, then doubles again. Globally, obligations race past $300 trillion. For a while, it seems manageable because the carrying cost is so low. But mathematically, the gap between real output and promised payments keeps widening. Stage three is quietly building beneath the surface. Then comes the pandemic. To prevent an economic freefall, governments inject unprecedented amounts of new money in a very short time. Stimulus checks, corporate backstops, emergency programs, each one justified, each one adding to the pile. Supply chains break, production stalls, yet purchasing power explodes. Inflation, long thought dead, returns with a vengeance. Central banks are forced into a corner. They can't keep rates at zero without letting inflation run wild. But raising them makes the debt suddenly far more expensive. They choose to hike. Within a couple of years, benchmark rates move from almost nothing to levels not seen in decades. Interest payments on existing debt explode. In the US, net interest becomes one of the largest line items in the budget. rivaling defense and social spending. At the same time, the petrodollar arrangement that underpinned dollar dominance begins to fray. Saudi Arabia flirts with accepting other currencies for oil. China builds parallel payment systems and signs long-term energy agreements outside the dollar. Russia, under sanctions, accelerates de-dollarization and pushes trade in alternative currencies. The no alternative pillar that supported dollar confidence starts to crack. Meanwhile, more than 60 countries now spend a huge share of government revenue just servicing debt. They are locked into a spiral where growth slows, tax income weakens, and yet interest obligations keep rising. This is the definition of stage 3, crisis of confidence triggered by mathematical exhaustion. In this environment, headlines argue about elections, personalities, and policies. But deep in their reports and filings, the largest pools of capital on Earth are making a different kind of decision. They're asking a simple question. If stage 4 brings some form of reset, whether through inflation, restructuring, or a new currency regime, what assets hold value across the transition? The answer, again and again, is tangible productive capacity, especially in energy. That is why oil companies with strong balance sheets and real barrels in the ground are buying back shares, raising dividends, and being quietly accumulated by investors who study history rather than headlines. Imagine waking up one morning to find that your savings account balance is the same number as yesterday, but buys half as much. Bonds you thought were safe are being restructured. Pensions are adjusted to reflect new realities. The stock market is volatile. Governments are announcing emergency measures. And financial news anchors keep using phrases like necessary reset and extraordinary times. That is what stage 4 feels like from the inside. Not an orderly policy tweak, but a violent repricing of what money itself is worth. In that world, the question is no longer which tech stock has the best growth story. It is which assets people cannot live without, regardless of what symbol appears on the currency. Energy sits at the top of that list. You can delay a phone upgrade, skip a vacation, or scale back entertainment spending. You cannot run trucks, ships, planes, factories, or farm equipment without fuel. You cannot maintain a modern military or supply chain without reliable energy flows. Even the green technologies touted as replacements, solar panels, wind turbines, electric vehicles are built, transported, and maintained using hydrocarbons. Oil is not just another commodity. It is the bloodstream of industrial civilization. That is why, in every major monetary reset, owners of energy assets tend to emerge with their relative position intact or improved. Look again at the balance sheets of the major oil companies. They throw off tens of billions in cash flow, fund rising dividends, and buy back their own shares at depressed valuations. They are not chasing hyper-growth narratives. They are consolidating real assets and returning cash to shareholders, assuming that in a world of unstable money, consistent streams of value will be scarce and prized. Billionaires watching this landscape understand they don't need to perfectly time the moment of reset. They need to own the assets that will still matter on the other side. So when Warren Buffett loads up on energy and Ray Dalio increases his stake in integrated oil giants, they are not making a short-term bet on oil prices. They are converting paper claims, dollars that can be printed at will, into claims on barrels that cannot. They are aligning with a pattern that has repeated from Weimar to Bretton Woods to the present. When currencies wobble and debt peaks, wealth flees abstractions and seeks reality. Land, infrastructure, commodities, above all, energy. The average investor is still debating whether oil is ethical, whether EV adoption will kill demand, whether the latest tech bubble will keep inflating. The quiet money has moved on from that conversation. It is preparing for stage 4. The uncomfortable truth is that you do not need to predict exactly what form the reset will take to see that something must give. The math does not lie. Debt cannot grow faster than productive capacity forever. Currencies cannot be stretched without consequence. And reserve status is a privilege, not a law of nature. The billionaires buying oil are not smarter because they have secret information. They are simply willing to look at the same numbers you can see and draw the conclusion most people emotionally resist. The system is late cycle, the pattern is in stage 3, and the time to own real energy assets is before stage 4 begins, not after.